Today, we're talking about corporate tax exemptions in the UAE, specifically focusing on eligibility and conditions.
Right. When the UAE introduced corporate tax in 2023, many founders really had the exact same core question in mind. Will my business actually pay it?
Exactly.
It's the fundamental question for anyone looking to understand their tax position as they operate or scale.
The high-level answer for you as a founder is that, well, in many cases, your business will not pay it immediately, and sometimes you will not pay it at all.
But to understand how this works, we really need to look at the overall framework.
Right. It starts with a 0% rate on taxable income up to 375,000 dirhams.
And a 9% rate above that threshold.
Yeah. Alongside those standard rates, there is small business relief for companies with revenue up to 3 million dirhams.
And finally, there is a 0% regime specifically for qualifying free zone persons who meet the required conditions.
We should emphasize right away that while this opportunity is significant, it is not automatic.
No, definitely not. It depends heavily on eligibility, your business structure, and your ongoing compliance.
Securing and maintaining this position means your business must register with the Federal Tax Authority,
You must maintain proper accounting records.
and you must consistently file returns.
For founders, the real challenge is protecting that zero tax position as the business grows.
Which is where the operating environment becomes essential. Operating within a qualifying free zone environment, such as Meydan Free Zone, helps you access this 0% framework where eligible.
Right, it allows you to manage corporate tax registration, reporting, and ongoing compliance through integrated solutions, specifically using M accounting under M+.
To understand exactly how corporate tax applies in the UAE, we need to look at the system's core design.
The system is built as a tiered, profit-based framework.
Meaning the tax is calculated on your taxable income, not on your total revenue.
This is a crucial distinction. As we mentioned, it's 0% on taxable income up to 375,000 dirhams and 9% above that amount.
The context behind this threshold is entirely focused on economic growth.
Yes, it was introduced specifically to support startups and SMEs, which account for more than 94% of businesses in the UAE.
So for early-stage companies, this structure effectively creates a built-in relief period while the business establishes itself.
There are a few key points you must understand regarding this profit-based framework. First, the tax applies to profits only after allowable expenses and deductions.
Right. Because of this, a high-revenue business might still fall within the 0% band.
Exactly. If your margins are low, or if you are aggressively reinvesting those profits back into the business, your taxable income might remain below the 375,000 dirham mark.
And even if your taxable income does exceed that threshold, the 9% rate only applies to the specific portion of income that sits above 375,000 dirhams.
Right. It is not applied to the entire income pool.
Beyond these standard thresholds, special treatments and additional relief exist within the framework.
These include small business relief, the 0% rate for qualifying free zone persons, and full exemptions for government bodies, approved public benefit organizations, and qualifying investment funds.
Let's examine the most common corporate tax exemption for founders in the early stages of growth, which is small business relief.
This is often the most relevant path to remain in a 0% corporate tax position.
To utilize this relief, there are specific qualifications your business must meet. First, your annual revenue must not exceed 3 million dirhams.
Second, the business must be a UAE tax resident.
And third, which is a critical administrative point, the relief must be explicitly elected in your corporate tax return.
The outcome of meeting these criteria is significant. If you are eligible and you elect a relief, your business is treated as having no taxable income.
Meaning zero corporate tax is payable for that period.
You should note that this relief is available for tax periods ending on or before the 31st of December 2026, subject to regulatory updates.
There are vital takeaways you must keep in mind regarding small business relief. We established earlier that the standard tax framework is profit-based.
But this 3 million dirham threshold is strictly based on revenue, not profit.
Exactly. Additionally, because the relief is not automatic, it requires claiming upon filing.
Right. It will not be applied simply because your revenue is under the limit.
And most importantly, even if you qualify for this relief, your business must still register for corporate tax. You must maintain accounts, and you must file returns.
Relief from paying the tax does not mean relief from the administration.
Now, For businesses operating within free zones, there is another highly relevant path. Free zone businesses can benefit from the 0% rate by qualifying as a qualifying free zone person.
Maintaining the 0% rate involves very strict requirements. First, the business must earn qualifying income.
Beyond the income itself, the business must maintain adequate substance in the UAE.
It must comply with transfer pricing rules.
And for financial reporting, the business must prepare audited financial statements.
Finally, there is a procedural requirement. The business must not elect to be subject to the standard corporate tax regime.
To be precise about what constitutes qualifying income, it generally includes transactions with other free zone businesses, international trade and export activities, and certain distribution and services provided outside the UAE mainland.
Free zone companies may still earn some non-qualifying or mainland income, but this introduces the de minimis threshold rule.
Right. Non-qualifying income must remain within a specific limit. It must be the lower of 5% of total revenue, or 5 million dirhams.
Exceeding this limit subjects the entire business to the standard 9% corporate tax rate.
Let's walk through a specific numerical example. Suppose your free zone company generates 8 million dirhams in total revenue.
We calculate 5% of that 8 million dirhams, which equals 400,000 dirhams.
Now we compare that figure to the absolute cap. 400,000 dirhams is lower than 5 million dirhams.
Therefore, in this scenario, your non-qualifying income must stay below 400,000 dirhams.
If your mainland or other non-qualifying revenue exceeds this 400,000 dirham mark,
you lose the 0% status. This calculation highlights exactly why free zone businesses must closely monitor their mainland revenue exposure.
because the primary risk is crossing that threshold unintentionally.
Exactly.
While we are looking at specific categories, it is also necessary to list the entities that are fully exempt under the corporate tax law due to their public or social functions.
The exact list begins with government entities and government-controlled entities.
It also includes extractive businesses, which are subject to emirate-level taxation.
Alongside non-extractive natural resource businesses, provided they meet specific conditions.
Public benefit entities such as approved charities and foundations are also exempt.
As are qualifying public pension or social security funds and qualifying investment funds.
The critical caveat for you to understand regarding these specific categories is that these exemptions apply only after formal recognition by the authorities where required.
Right, they're not simply assumed statuses.
Shifting focus to foreign businesses, we need to clarify a common international founder assumption. Many assume that selling into the UAE automatically creates a tax obligation.
Selling into the UAE does not automatically create a tax obligation. The trigger is presence, not exposure.
There are two specific conditions where corporate tax applies to a foreign business. The first condition is having a permanent establishment in the UAE.
A permanent establishment includes having an office, a branch, a warehouse, or a dependent agent with the authority to conclude contracts on behalf of the business.
The second condition is having UAE-sourced income that falls within the scope of the rules.
The practical impact here is that operating remotely without a fixed place of business keeps a company outside the tax net.
Tax exposure only arises upon establishing local presence, like hiring staff, opening an office, or setting up a UAE entity.
We also need to address businesses that invest, hold subsidiaries, or build group structures.
For these entities, we examine the participation exemption, where certain investment income remains outside the corporate tax net.
This includes dividends received from a qualifying company.
It includes capital gains from selling shares in a subsidiary or an investment.
And ownership-related returns like liquidation proceeds.
The precise conditions are clear. The UAE company must hold at least a 5% ownership stake or have an acquisition cost exceeding 4 million dirhams.
The company must also meet minimum holding period requirements along with underlying taxation or substance requirements.
This makes the UAE a strong holding jurisdiction. It allows profits to move up or exits to be realized without creating additional tax exposure, provided the structure is correct from the start.
Which brings us to a core misunderstanding. Corporate tax exemptions in the UAE require ongoing, continuous compliance.
To keep an exemption, there are exact ongoing requirements. You must maintain proper accounting records.
You must file corporate tax returns, even if the tax payable is zero.
You must meet substance and activity requirements.
Monitor your revenue thresholds.
And follow transfer pricing rules where applicable.
The bottom line is that in the UAE, relief does not mean no compliance.
Because of this, there are common risk areas where exemptions are lost. One major risk is free zone companies generating mainland revenue beyond the allowed limits.
Another is revenue exceeding the 3 million dirham mark without planning for an exit from small business relief,
Mixing personal and business finances is also a significant risk area.
along with not preparing audited financials where they are required and missing registration or filing deadlines.
This is how Meydan Free Zone mitigates these issues. The real risk for founders is not the tax rate itself, but losing eligibility due to incorrect structure, improper records, or missed filings.
Operating within Meydan Free Zone grants businesses access to the 0% framework where the qualifying free zone person conditions are met.
The M Plus ecosystem helps manage this. Through M Plus, businesses handle corporate tax registration and return filing directly with the federal tax authority.
It provides bookkeeping and financial records through M Accounting.
It facilitates ongoing compliance monitoring and reporting.
And it manages license, business activity, and document updates as the business evolves.
Managing these elements within the operating environment, rather than treating them as separate tasks, significantly lowers the risk of losing the 0% position.
Because eligibility depends entirely on consistency.
To summarize, the UAE corporate tax system is designed to support growth. It allows many businesses to operate at 0% through standard thresholds, small business relief, or the qualifying free zone framework.
But these exemptions are not automatic. They require the right structure, the right revenue mix, and consistent compliance. The key question for founders is whether their business is set up to protect its eligibility as it grows.
Choosing the right jurisdiction, keeping accurate records, ensuring timely filings, and maintaining aligned activities keep a company within the zero tax position.
Operating within a qualifying environment such as Meydan Free Zone helps businesses do this from the start, using integrated support through M Plus and M Accounting to maintain the 0% advantage as the business scales.